Gas prices are through the roof, the stock market's crashing, and inflation is out of control. In this video, we're going to be talking about the truth on how the stock market performs during times of high inflation and why over the next couple of years, we can very likely see companies report record profits, yet still have their stocks get destroyed. Stay to watch to the end of this video. It's important and you're not going to want to miss it. So I'm sure a lot of you already saw the headlines today and how inflation rose by 8.6% in May, which is the highest level since 1981. This is insane. Inflation's getting out of control and the stock market tanked off of that news. So normally a little bit of inflation is good for the stock market and the economy overall because it promotes spending and economic growth. But when we see inflation at 8.6%, or at least that's what it's reported at, it's probably a lot higher than that. It's not good. Like that's unsustainable and that's a bad sign. So check this out. We can see a study done from Hartford Funds from 1973 to 2021 showed that when inflation is less than 3%, the stock market outperforms inflation 90% of the time. 90% of the time. That's awesome. But when inflation is greater than 3% and it's rising, the stock market only outperforms inflation 48% of the time. So basically when inflation's low, stocks do great. But when inflation's high and rising, sometimes the stock market does good and sometimes it does really, really bad. So we're seeing the bad side of the stock market right now, and there's a couple reasons for that, and we're going to talk more about what's likely to happen over the next couple months in just a minute. So if we continue to scroll down, you're probably wondering, all right, why does high inflation hurt the stock market and hurt stock prices? We can see a comparison between the inflation rate on the x-axis, and we can see the US PE ratio on the y-axis. We can see the higher inflation gets, the lower the PE ratio is. We can see that when inflation is around 2%, you could have PE ratios around 20. But when inflation gets closer to, let's say, 10 or 11%, those PE ratios get cut in half. So that is really, really bad. And basically what it shows is when inflation's high, people are less willing to pay a high multiple for a company because basically when inflation's out of control, like we can see with the US 10-year Treasury right now, the US 10-year Treasury is at 3.1% and just a year ago it was at like 1.5%. So when you see inflation getting out of control, you also see bond and Treasury yields shoot up, which gives investors more opportunities to invest elsewhere. So check this out. Let's say you're looking at AMD, right? This is a random example, but it's a good example nonetheless. So let's say you're looking at AMD for a 10-year investment, and you say, you know what? I want a 2.5% return, and let's say you assume revenue growth of 9% and a PES ratio of 5, right? Basically, the main thing to know is you're investing into AMD for the next 10 years, and you want a 2.5% return. A year ago, that would have been fine because 10-year treasuries were at 1.5%, but you could say, you know what, since I'm investing into a stock and stocks are a little bit more riskier or a little bit more risky than bonds, I want a 2.5% return, which is slightly above the US 10-year treasury. So if that was the case, you can see that you could pay $123.79 for AMD stock. But now that the US 10-year Treasury went from 1.5% all the way up to 3.15%, and it's still rising, you might say, dang, is this going to be at 4 or 5% in a year from now? You don't know. So basically, you want a bigger buffer in case inflation continues to be out of control and in case 10-year treasuries continue to rise. So because of that, instead of requiring a 2.5% return for AMD, you might require a 6.5% return for AMD, which would bring the price you're able to pay for AMD stock down from $123 to $84.42. So basically, when inflation's out of control, treasury rates rise or treasury yields rise, which gives investors more opportunity to invest elsewhere in the market to get relatively safer returns. Another thing to keep in mind is that let's say you look at this example that I drew up. Let's say you have a time of low inflation and company A has earnings of $20 million and they're trading at a PE ratio of 40. Their valuation would be $800 million. But remember what we said about what happens during times of high inflation. PE ratios fall. So instead of having a PE ratio of 40, this company might have a PE ratio of 20. And even if they have higher earnings, even if they take their earnings from $20 million to $30 million, their valuation would still fall significantly. So check this out. This company literally increased their earnings by $10 million or 50%, yet their valuation still fell by 25%. That is insane, and that is why stocks are falling now, and that's why some stocks will continue to fall even though they will report sky-high and record earnings. It's because during times of high inflation, investors don't give the same PE ratios to just stocks because there's other opportunities out there among other reasons. So this is very, very important. If we continue to scroll down, it's important to note that not all stocks are treated equally during times of high inflation. We can see that energy and equity REITs normally perform a lot better than mortgage REITs and a lot of tech stocks during times of high inflation because it's easier for energy and equity REITs to pass on the higher input costs from their business to their clients. Basically, like oil stocks, they're booming right now. You could say even a lot of real estate stocks are booming up as well. So basically, if the company you're investing into can easily pass on their higher input costs to their consumer and their profits can stay high, then they should do well during times of high inflation. So keep that in mind as well. But yeah, it's very important. I also want to look through a couple of notable points throughout history where we had crazy inflation. We could see in the basically from 1966 to 1980 to 1981, inflation was just booming to the upside. And on this, like the S&P 500, it didn't do too bad during that time. We can see this giant green box that highlights that period of strong inflation, and that's not a good thing. But the stock market, it was just all over the place. It didn't necessarily tank down. It was just up and down, up and down, up and down. There was a lot of consolidation and just chop. Now, there was one notable time, which was the 1973 oil crisis, which really affected the stock market that we could see in this red box. So basically, when we see times of high inflation, it hurts some stocks a lot more than others. Generally, it's not good for the market overall because it really hurts the PE ratios of everything, and that really makes it hard for stocks to appreciate in value, kind of like I showed in this whiteboard example, right? We're going to see companies report record earnings, but they can still easily fall because of the problem we're having now with high inflation. So keep that in mind. But all in all, I think over the next couple of years, there's going to be a lot of chop. There's going to be a lot of volatility, similar to what we saw in the 1970s and 1980s. Yes, there was a lot of downward selling pressure during that time, but there was also a lot of upwards buying pressure too. It wasn't all selling pressure. It was just very, very volatile. So keep that in mind. Some stocks hold up a lot better than others during times of high inflation. But the biggest thing, no matter what, is over the next couple of years, there will be a lot of opportunity in multiple different ways. If you're looking for short-term trading, you have to be prepared to play the upside and the downside. And if you're looking to start a long-term portfolio, it is crucial to understand that no one can time the bottom. The S&P 500 is down quite a bit right now, and there's a lot of panic and fear out there. If you're a long-term investor, the best thing to do is dollar cost average, and over time, good things will happen, right? But short term, anything can happen. You have to be prepared for that volatility. But overall, I hope you guys learned a lot from this video. The whole inflation topic when it comes to stocks is rather complex, but I really think this video should help a lot of people. If you learned something, do me a favor and let me know in the comments down below. It helps so much more than you guys realize, and it means so much to me. So if you learned something, comment down below, subscribe if you like the video. I have a bunch more of these style of videos planned for the future, and I'm very excited about them, so make sure to subscribe. Stock market's going crazy. Thank you guys so much for watching, and have a great weekend.